Yeah, I want to talk and shift gears, unless there's something I should be asking and I'm not asking on that. But I want to shift gears to really the capital stack on putting these deals together. We want to really start. You mentioned earlier about some of the conversations about where the investor fits in. We're asking, hey, you're putting your $100,000 in, and who owns it? What's the institute structure? All those things, but where do they fit into that structure? How important is it to just know the simple question of who owns the deal? You mentioned earlier the syndicator of the syndicators.
I mean, I've been sent deals that there was a deal that we were selling. We picked a buyer, and I was sent the deal for equity from another person that was syndicating into the syndication of the deal, right? If you think about like that circle. And so I'm thinking like, okay, who's that equity and how many times are they getting promoted? So typically if you invest as an LP investor, you're going to pay a fee, right? Whether it's 1% or what have you. Well, what happens if I pay a fee to this syndicator, then this syndicator pools this money and goes and puts it in the deal with this syndicator, and this syndicator takes a fee, right? I'm further diluted. So now I'm in the hole further before I even got started, before the market's even gone.
Right.
So that's where I go oftentimes when I'm saying like, hey, where are you at in the deal? Is that understanding the organization of, okay, who owns XApartments.LLC? That's the entity that's buying that. Who's the general partner of that? Okay, that's the group that I'm partners with. Great. I'm the LP there. Great. Now this GP is shaved off a piece, whatever. The further and further you get down, the more risk you're taking, right? So the business plans and stuff will show you the return parameters, but it doesn't show you that the risk is getting greater as you go or as it changes. So the capital stack's always simple, right? Debt's first. They get paid back first. If the lender will allow on certain types of deals, there might be, like we said, a preferred equity piece or a mezz piece. I like those plays. I like to invest in that tranche. I like the risk profile. Now your upside's fixed if you invest there, so maybe it's a 11%, right, cash on cash, it's fixed. But once the deal sells, like that's all. Are you
looking at that in like more of high risk environments or
just diversification?
Yeah.
I mean, or if I get skittish on a price per pound, where this thing's trading at 300, but I really like it at 260. Well, if I put my money in at a mezz piece, if they offer it, then I'm in at a basis that's $30,000 less than the equity behind me type thing. So, and there's a place for all of it. Like both work.
Tell me a scenario where that could not work out favorable. You touched on a little bit about the equities, the last one in or the last one that gets out, I guess. And if things change, it may just be,
I mean, people
turn into nothing.
People say, well, I don't, and I will say sometimes it doesn't matter what the value is. I'm not a seller. Well, that's fine if you're hitting your loan covenants, right? So the only thing that would change is your debt service coverage ratio goes, your loan covenants. Now you got to get an appraisal. So now the value's changed on your deal. Well, now the lender's who's driving the ship, right? The lender's like, hey, you need to have 30% equity in this thing at all time. Said it was worth 10. Now it's worth 9. We're upside down here. Mm-hmm. So once that shifts, then there's capital calls and all sorts of different things that the PPM will go in. And that's the other thing I say is, investors, like, unless the deal, I've invested in deals that don't have PPMs, but it's a group that I know, and there's like 3 investors in the deal. Most deals syndicated should have a PPM, right, for your protection. It protects the investor as much as it protects the sponsor. So just basically, at that price, if there's mezz, if it changes, if whatever, you're going to get diluted the most.
Mm-hmm. Yeah, and that all affects your risk profile. What are the questions you're asking those investors when they come in terms of their risk profile, and where do they need to be?
Yeah, so we do Reg D offerings, which Tom will be able to tell you about, and people identifying and being an accredited investor. So we don't. I take people's play money. I don't get their real money, right? So they're either doing their stockbroker or whatever else they're doing. I'm getting, hey, I have this capital. I want it to work. I want it to go, and so I want to understand how much money that is to them, right? Because if it's a lot of money to them, it's not going to be a good experience. Typically, because each quarter they're going to be like, hey, you're off 0.1%.
Right.
You're like, what's going on? What are you going to do to fix it?
Right.
Well, a resident was 2 weeks late paying their rent. Like it'll
Sure.
be caught up next quarter, whatever.
Yeah,
right?
timing.
It's too tense. And so also what their goals are. I mean, that's the most important question is, when do you need this back?
Yeah.
What are you trying to do? And so with investors that work best with us, it's investors that are, hey, I've made my capital. I have this obligation to preserve it and to grow it. Oftentimes they'll get, hey, I got this capital that's going to pass on or whatever, but I certainly like living off the distributions,
Sure.
right? So that's what makes them feel wealthy is, hey, I put this over here for my kids. I like getting this cash flow because that's how we live, and that's what makes me feel good. And so that's probably the nucleus of most of my investors is that type of strategy.
And when are you having those conversations?
All the time, but it takes. I always tell people that if they call or they're, hey, let's get on the list or whatever, that oftentimes there's a year or two, maybe three. They watch deals go by.
Relationship.
Right. They have to make sure that I'm going to do what I said I'm going to do, and
Right.
it just. If I ever call and say, hey, I need your money like that, like you should run.
Right.
So it's if the deal's good enough, it will fund.
Yeah. And are in terms of the stack, is there ever tell me the scenario when the bridge money or the when is that?
I mean, we're talking about it right now. So there's a property that we're looking at. The owner's owned it for 12 years. He hasn't touched it. There's lots of just what I would say low-hanging fruit. The property location's amazing. It's tired, like it needs stuff, amenities, what have you. But the demographic around him is very affluent, and so this is a thing that we think we could go in, put $2 million of capital, just go as fast as we can, paint, rebrand the whole thing, and then take us about a year to reprofile the tenant base. So, but doing that, we think that there's $300, maybe $400 a month on the bone for those. Well, if we're successful in doing that, we don't want to lock in our debt today. So this is where we're going to go in. We would bridge it because bridge terms and interest rates are favorable. We would go in, get those rents up, and then roll into a Fannie Freddie type product once we have the value. Because we just think we can increase the value so quickly that we don't want to be stuck where, you're equity rich in a deal, but you can't get it out.
Right.
There's no way to get it out.
Right. And that's in the long term. That's the long term debt scenario. You mentioned now's not a good time for that. I mean,
we found one, but I haven't, because it's hard to find value add deals. I mean, again, there's a lot of smart players out there. I mean, we get calls literally every single day of people wanting to buy property, unsolicited offers. So it's very difficult to imagine a property owner, and they're good at identifying this one has not been touched in 10 years. You've owned it for 10. Those are on everybody's call list. So we just happen to own a property that's next door to the guy that owns this one. So we're in a different market. We own a property right next door to him. Happens to come up that he owns this other property over there, and is thinking about maybe making a move on there, and so that started the dialogue.
Yeah, very interesting. So to begin the question, tell me about your team. How do you work through all these? You're talking about bridge, finance, preferred debt, preferred equity, your mezzanine, all of these construction lines. The value play. How do you even work through those conversations? Is this something you take on, or
Sure.
your team, or
all of it?
Yeah.
I mean, there's so the relationships are big, just like you'll see with a Tom Morgan, right? He's the guy that I would say is on the team. So he does a ton of private placements for a lot of guys in town and a lot of deals, and he just is very versed like on tax law. So he makes our team an expert on tax law, right? He's a resource. The management company, the operating company, you know, I have two partners there, and they're heavily involved in everything we do. One has a heavy finance background, like institutional type finance background, and the other one has a heavy operating background. And so they're dividing and conquering. So if we see a deal that we like, you know, Dale's his name, he's going to go in, he's going to understand all the operations. Ben's going to start working with me on the capital, the underwriting, getting things prepared for the lenders, documents, that type of stuff.
Yeah, and that's important. So that's the ability to structure those investments for that passive investor. I mean, you'd be able to have strength in that thing. Not everybody has that in-house, though, right? So they're just counting on shopping and finding these scenarios. Because 1 point here and there, half a basis point, I mean, it could change scenarios for investors.
Yeah, I mean, if someone's trying to be a syndicator and they're trying to get in there wanting to go now, like the first place I started when I started doing this was with the relationships, right? So my first meeting was with 2 different lenders. You know, like, can I even get a loan? Like, what's that going to take? Like, do I have the balance sheet for it? You know, all of it. And then it was immediately after that, it was with Tom on structures and getting entities and getting all the stuff set up. And so you can be in the space, you can put together a really big team that's not on your payroll until you do a deal, per se. So that's an advantage that's how we outsource a lot. Like, and that keeps it competitive. And for all the stuff that you're doing with innovation and whatever, like a lot of those companies, like those are what I would call partners of ours, right? Like we rely heavily on them. Now we have an internal team that knows what to do with that data and what to do with that stuff. But there's so much stuff in the multifamily space now that can allow you access to all of it.
What do you tell a new, well, I wouldn't say new investor, but somebody that's trying to structure things today? I mean, you mentioned your team. I mean, if you were to build a company today, I think people would build them differently than we're used to. Like even the office space stuff, you mentioned people working at home and the shift to sort of a hybrid working experience. Starting a management company, you know, before, you know, it was like cubicles of accountants and things looked differently. If you're looking at a deal now, and I guess it depends on the deal, but what's the most favorable sort of capital structure that you see as the less risk? But
well, the thing is you're seeing the big boys are playing with debt funds now because we've had so much appreciation and things are going up. The way that they're capitalizing these to keep their leverage up is that they're doing debt funds. Debt funds come with a whole different scenario of, you know, risk parameters are not for everyone. Me, I'm just boring. I just like to buy a deal and fix the debt, have lower leverage, have lower reserves, grow it. If we're successful, that's fantastic. That, you know, we want the certainty of the cash flow as much as possible.
So as you stack everything, that certainty of cash flow, I mean, that's the obvious. But as you do things, if it's bridge and all these other, preferred equity and things like that, I mean, those things require different levels of even asset management and compliance and reporting, and that can be distracting as much as anything else.
Yeah, I have never personally done a preferred equity. I've been an investor in preferred equity in MEZ, but I have never structured that on one of our deals. So it's, again, these investors are, you know, the personal relationships. And so I need to be as aligned as possible. If I moved into more institutional type equity to hit some of their parameters and whatever, then I would be forced to do some of this structuring.
Yeah, because I mean, I think it would be an early signal too, like the more pressure you're putting on the deal too to get the deal done. I mean, maybe the market's tighter, that people have to get aggressive to get to the table if they don't have that.
And you get value so if the new buyer can come in and put debt on, there's tremendous value in that. So where I've self-admittedly have capped myself is one of the deals that we were trying to sell, we fixed the debt on there long term. We didn't know we would hit 6-year numbers in year one. But the problem is somebody would have to assume that debt. So that would lower their leverage. So because my prepayment penalty to pay off that loan is too expensive. But if they could put new debt on there, they'd probably pay an extra, whatever the number is. It's definitely worth more if they can come in and put today's debt on there, because today's debt is lower than it was, a year ago. Now, if that flips, the counter can happen, right? Now you have a below market loan, and maybe you'll get paid for that a little bit. So it's just...
Yeah. Yeah, no, I'm in a scenario, I'm very familiar with that scenario. The yield maintenance on some of these assets, if you've been able to come in and put new debt on it, there's plenty of cash out there to buy. It's fascinating to see the trends happening. What excites you most about sort of the whole deal? Is it the capital structure? Is it the store? I mean, you mentioned story, you got the development part. Is this what keeps you alive the most?
It's actually just the community. I mean, as cliche as it sounds, it's people's homes. And, if we get to have a direct impact on people's lives, like sometimes it's fascinating. We'll talk about, and you watch, on a property, 200 residents, maybe 400 people live there, and how many different life situations do they have going there? And how do we, good, bad, indifferent, it's all right here. So there's a huge responsibility there. And when we get these properties, we have one right now in North Scottsdale, the community's fantastic. The property manager, it's just running so well. And we get letters all the time, which never really happens because it takes a while to reposition these, of just, hey, I lived here for 5 years. The last 2 years have been amazing. Thanks. We loved the team there. I like coming home. Thank you for this. So that's the stuff that's fun. Yeah. Because if we do all that stuff, then the numbers follow. And don't get me wrong, sending the investors a quarterly check, or this one that we just sold,
sure,
that's fun too. That's really fun. But that's just a byproduct that we really like the day-to-day of, hey, let's make this an amazing place to live. Mm-hmm. We love living here. We're here. We want to make it better. So we're not interested in, quick fixes. We want to, because we think that we're going to own it forever. Right. And the stuff that we've sold, we're hopeful that the people that have bought it, feel that they have bought an amazing project, because everything that was fixed or everything that was done was with the intent that we would have it forever. Right. So, yeah.
Yeah, it makes for the story on the exit too more attractive. You're buying an asset that owner cared about it, and ultimately there's value in that community engagement as well. From a risk standpoint, of you're buying a deal that isn't undermanaged, isn't where people are driving up reviews that are problematic, that take time to fix. Do you guys factor that in your approach to looking at new deals? I mean,
yeah, it's hard work, right? It's supposed to be difficult. There's not an easy way. I mean, you could come in and say, whatever benefit whatever thing you're going to do for that property, the resident only cares about one thing: what are you going to do to my rent, right? Because you haven't earned the trust, you haven't earned anything. So they're just, that sounds great, but what are you going to do with my rent? Right. And no matter really what you give, the value proposition is always going to be difficult. The intangibles are, I really like my neighbor. I really like going in the donut on Friday. I really love hitting the pool on the weekend. All these things.
The energy, the location.
All of that. And so it just takes time. And you're gonna, if you're the bigger the reposition you're doing, the harder that's going to be, and the longer it's going to take, and the more the more challenges there'll be. That's what's beautiful about new development is you get to start day one with your culture, and that was probably the most fun that have gotten to have, because there was nobody to. It was just us.
And what gave you the confidence to build that community? So you structure. You mentioned the time is turning away. Tell me about the capital structure in that scenario where you can get the things done structured where you're operating from a position of strength. Then you can focus on really the long-term things that truly are valuable and tangible, like the story, the culture, what this sort of project becomes. If you're worrying about other things, maybe they don't focus on those elements because they're trying to get to a deal point.
I mean, we really hit that deal almost to the dollar. So what happens, we had weather delays, right? There's weather up there. We had contingencies. We had, one investor. We had the lender. And then the week we were supposed to open was literally the day we were supposed to open is when the governor said, hey, we're on lockdown.
Oh, perfect.
The day. And I'm like, oh, this is how developers go broke. Like, this is the part you can't underwrite. Here we go.
Yeah.
And so we, again, just, everybody's buying ozone machines. I mean, everybody was just trying to figure everything out. And so we changed our capital deal where we had certain fees and things that were going to happen. As we went back to all the partners and we were like, hey, we're all in. Like, nobody's touching a thing here financially. Like, wrote to the lender, this is where we're at. This is how we're going to combat it. Like, whatever. And it all came together. But that just came from also just having partners that were literally fully committed. So nobody looked at that deal when we were delivering the news and we had 18 pre-leases that all walked away in, a 3-day notice because of all this. Nobody looked at it and said, how do I get out?
Yeah.
Everybody was, what do we need to do? What do we need to do? Sure.
And in terms of sponsors on guarantees and things like that, what are you seeing in terms of?
That's never the fun part. I mean, the typical, reposition is, have your bad boy carve outs, that type of stuff.
Sure.
New development, if you're experienced and you have a track record, like you can, for lower leverage, you can get non-recourse. So the one up there, like in a tertiary market, that wasn't the case. It was full recourse, and so we like being a partner, we got to sign on that, and but we were committed and we were ready, and obviously it worked out. But I know a lot of developers that was tough, in the last cycle. So that's always kind of right here because it turns quickly.
Yeah. No, absolutely. And it also is nice to be, what did you say, all in, or, I go back to that communication, and you put the deal together with a certain structure, and then something happens, and you just have to make things work. Let's see. So what am I missing here? So what I'd like to do is we're going to bring in our next guest here in just a moment. We'll probably take. I've asked you to answer a lot of questions here, Tanner. So it's been awesome. We've covered on some of the elements. I don't want to take away from our next session, but we'll get started here in a minute. That is using data to reduce bias in real estate. And you mentioned already Mark Taylor. We've got John in the studio with us, so we're excited about that. Anything you want to leave and final thoughts around really the sort of the capital, the structure, what investors should be asking about those things? I know that it's complex, and the more touch points you get, it starts to look, and maybe it's that PPM, and that sources and uses of how everything lays out. Any final thoughts you want to leave us with?
I think you have all I know, and it only took not very long. So there you go.